You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
I'm Ron DeLegge with ETFGuy.com, and we're pleased to be joined by Darwin Abrahamson. He's the CEO of Invest and Retire. It's a Portland, Oregon-based company that focuses on ETFs inside 401k plans. Darwin, it's great to catch up with you.
Good morning, Ron. It's great to be here.
I want to talk with you and debunk some of the misinformation about exchange-traded funds and 401k plans. Let's begin with the idea that 401k participants would be tempted to day trade ETFs. Talk about that.
Well, Ron, the participants are not going to have any more access to trading ETFs more often inside a 401k plan than they are with mutual funds. And one of the primary criteria for that, I'll have to say, is they can't, because ETFs have a 3-day settlement on the ETFs, and where mutual funds can be settled in 1 day. So if we're going to have active trading inside a 401k plan, it's a lot greater ability for the participants inside the plan to do that with mutual funds compared to ETFs.
Now, what about the other argument against ETFs inside 401k plans that, well, look, you've already got index mutual funds which have the same cost or lower cost than index ETFs. Is that a valid argument?
It is not, Ron. And my answer to that, whenever I'm talking to a prospective plan sponsor, I will always ask them one question. And that question is, did you bail out of your mutual funds during the downturn in 2008? And invariably, they will say, no, I did not.
Liars.
Yeah. I said, and then when we had the next market downturn, did you bail out? And they say, no, I did not. And I said, well, since you were a good person inside that mutual fund, you paid all of the trading expenses for all of those shareholders that were bailing out. Right. And these managers were having to sell into a down market, which was compounding the losses and moving up the trading cost. And then exactly the opposite happened when the market come back up. Shareholders of mutual funds bail back in, and managers are having to buy in an up market. And you, as a good shareholder staying in that mutual fund, paid for all of those expenses. And with an ETF, that does not happen. You do not pay for anything that happens with any other shareholder moving in and out of an ETF.
Now, one last question I want to ask you pertains to the investment menu that is given to 401k investors or 401k participants, which is, quite frankly, limited with index mutual funds versus index ETFs. Talk about that.
You're correct, Ron. With index ETFs, we have a lot larger number of index ETFs that cover not only the typical asset classes, but we can also offer them ETF indexes. They're not even available with mutual funds.
So you're talking asset classes, not just stocks and bonds, but other areas? Commodities.
Yeah, we can get into commodities and a lot of other indices that your typical mutual fund does not have.
And that's important because a diversified portfolio is not truly diversified unless it's diversified.
That's correct. And there's one other advantage too with an ETF is your ETFs are truer to the indices than what a lot of your index mutual funds are. It's not often at all to see them not tracking the indice as closely and not have the correct basket of securities inside that index as compared to what the ETF does.
Very good. Well, thanks for joining us, Darwin. We hope to catch up with you again very soon.
Okay. Thank you, Ron.